Hi everyone, it's Konrad Bobilak here, CEO of Investors Prime Real Estate and author of Australian Property Finance Made Simple. And I've made this really cool video here today for you, talking about specifically whether you should be timing the market or whether you should be investing long-term and just putting your money into the market whenever there's an opportunity to put in money in. A lot of people that I've been speaking to over the last few years, especially given the fact that we are near the top of the property cycle right now in Melbourne, are speculating on the fact they're going to wait for the market to hit the peak and then have a small correction and then go in and snap up all those bargains. So the question is this: should I be buying property right now, given that Melbourne is 11 o'clock on the property clock, or should I wait for 2 or 3 years and buy something that's cheaper? And that's a very valid question. So I made this video here today for you just to basically explain the concept of property cycles, where you can get your own independent information to verify all this stuff as well, and also just to give you a bit of feedback about some of the thoughts that I have about this and other investors who've been investing now for over 20 years. So welcome to the video. Also, at the end of this video, I'm going to give you a special bonus, access to a 12-hour online home study on property investing. So make sure you watch the video to the very end. Bit of a disclaimer before I get started. Obviously, I'm not here to teach you how to become a multi-millionaire property investor, and all the information that I'm giving you is based on hypotheticals, okay? Just like there's no guarantees in life, just like joining a gym. Just because you get a gym membership doesn't mean you're going to grow muscles, right? You got to go in and do the heavy lifting and take all the supplements. Same thing what I'm about to cover today as well. Bit about myself now. I'm not going to spend a long time on myself, but just background in terms of why I'm able to talk to you about the following topics today. I'm actually a mortgage broker and a real estate agent. So the topics that I'll be covering today, amongst other things, will have to do with property cycles and also a little bit of finance as well. By the way, if you are interested in learning more about any of the topics covered today, feel free to grab a copy of my book by going to the following website, bookonfinance.com.au, or any good bookshop carries the book as well. So let's talk about the property market. Now, obviously the market's done exceedingly well, far beyond anyone's expectations for the last 10 years. You know, if we look at just June 2006 to June 2016, okay, and by the way, the best data that I have, and this is a statement for all data that's captured in real estate, is around 6 to 12 months old, okay? Because that means all the sales have been compiled together by all the agents and given to RP Data and Residex and all the other companies that report data. So a lot of the data I'll be showing you today, it could be 6 months old or even 12 months old. But you can see there Melbourne's done really well. For detached housing, Melbourne median prices have gone up by 85%, and even for apartments, 60%. So, you know, if you held your money in real estate for the last 10 years, you've done it really well. The challenge is this: very few people actually end up property investors in Australia, which to me is unbelievable, given the fact the market is doing so well. In fact, if you look at the Australian stats from the ATO, out of all the pool of investors in Australia, 72.8% only have one property. And I want to cover why they only have one property with reference to timing and property cycles. There's only 0.9%, less than 1% of investors have 6 or more properties, which equates to just over 15,000 homes. So there isn't a lot of investors out there, per se, in the property market. There's a number of reasons why, and if you watch my other YouTube videos, you would have known the biggest obstacle people have to building wealth through property, apart from the obvious, which is psychology, is finance. If you keep borrowing money in your own name, you're going to end up in consumer lending. If you keep building your property portfolio through corporate trustees and trusts, you end up in business banking, and that's where you want to be. And that's the number one mistake people make when they're starting out buying real estate. They keep buying stuff in their own name. Guys, don't keep buying stuff in your own name. Make sure you understand the power of trusts, corporate trustees, and business banking, because that's really where the majority of these people end up, and that's why they build large property portfolios. But let's talk about the reality of why so few people succeed in real estate investing. And the reality is most people have no strategy at all. You know, let's face it. Most people, the way they buy real estate is they get up in the morning on a Saturday to get the paper and the milk from a milk bar. They drive by a street, they see auction for, you know, sign, they go, oh yeah, that looks good. I'll pop in and have a look. Chances are, because it's around the corner from where they live, the property is comparable to what they live in, so it's a comfort zone thing, and they end up bidding on the property, buying it, and then Monday morning, in a panic, they start ringing up the mortgage broker, their accountant, finding out, can I actually settle this property? And number two is, should I be buying it in my own name or a trust? Which is not the way to do it, would you agree? So most people have a buy, hold and pray investment strategy. They buy a property 3 to 4 k's from where they live, and they just go, God, just make it go up in value, please. You know, and there's no thought process beyond that. And the reality is, just because you're investing in Melbourne, which happens to be, in my opinion, the best property market in Australia, there is no guarantees you're going to make money, because the reality is, even though the median price has gone up, out of the 390 suburbs that make up Melbourne, 192 suburbs haven't doubled in the last 10 years in terms of median price appreciation. Only 198 suburbs have. So half of Melbourne virtually has not doubled in the last 10 years. So there is no guarantee just because you're buying something in Melbourne, you're going to make money. You have to do your research and due diligence, and you've got to have a strategy. And the reality is, why so few people succeed investing in real estate is because they have no plan. And if you fail to plan, you plan to fail, in my opinion. And that's the reality. You know, and there's really 4 critical parts of building a large property portfolio. And this is actually the topic of my next book that I'm writing currently. Number 1 is you've got to have the right psychology. Without psychology, there is virtually nothing. Mindset is going to make or break you in this industry. Number 2 is you've got to develop a plan. Guys, you've got to develop a strategy written on paper with dates. You know, if it's not written down, it's just a dream. Okay, so you've got to develop a plan. And the most important thing is number 3, you've got to have access to the right experts, the right accountant, the right mortgage broker, the right property solicitor, you know, buyer's advocate, real estate agent. That's the hardest thing, is to find these people and assemble them into a team that will propel you to the next level. The final thing is property selection methodology, which is kind of what we're talking about today. We're not really talking about selecting properties, but we are talking about timing of buying the property, which is timing in the market. So really, if you want to understand what does it really take to succeed in real estate investing, it's those 4 things combined together, overlapping, and that's the very definition of success. If one of them is out of sync, it's very difficult for you to succeed in real estate market, in my opinion, after being in the industry for over 20 years. Now, people say I'm going to wait for the best time to buy real estate. I say don't wait to buy an investment property, buy an investment property and wait. Okay, you've got to allow compounding to do its thing. And this is the secret, is just waiting, buying, holding and waiting for the market to do its thing. If you look at the real estate property growth cycle, you know, we have the peak of the property market, which is kind of where we are currently. And I'll show you exactly, by the way, how to verify this information. Don't just take my word for it. I don't just sit there at home and go, oh, I reckon we're about 11 o'clock on the property clock right now. It feels like about 11, you know. I'll show you how you can actually do your own independent research and reading how to get this information. But we're kind of at the peak of the market in Melbourne, about 11 o'clock on the property clock. We are going to have a downturn, and I'll explain exactly what that means, because the downturn doesn't actually mean that suburbs go down in value. We're going to have a downturn, we're going to have a decreasing median price across the 390 suburbs, but I can tell you now, most suburbs are not going to have any corrections in Melbourne or Sydney. Then we have the bottom of the property market, which in my opinion is the best time to buy real estate if you've already got an established property portfolio, mainly because this is where you can negotiate terms of settlement, vendor discounting, smaller deposits. You can ask for freebies to be thrown into the property. You can get upgrades. You can get amazing stuff here. Here you can't get anything, okay? Because the developer knows whatever they put out into the market, it will sell. So as a long-term strategy, if you've already got 5, 6, 10 properties, what you want to do is what Warren Buffett talks about as counter-cyclical investing. You want to be buying properties at the bottom of the market, and you want to be locking in your valuations on your existing properties at the peak of the market, because you're getting all these comparable sales from people that are just overpaying for property. Now remember, those comparable sales only last for 3 months, and then they expire, they're no longer relevant. So you want to basically increase your lines of credit on your established property portfolio and then buy at the bottom. Now, what happens if you haven't got any property? Okay, there's no point waiting to the bottom, because the bottom could be 5 years from now, could be 10 years from now. What you want to do is really buy any time you can buy, because it's getting so difficult to buy property right now, with APRA influencing the major banks and really changing the whole landscape in terms of serviceability criteria and credit scoring algorithms. people are finding it difficult just to get into the market. So my advice is definitely buy as much as you can, as often as you can, in line with your overall investment strategy. Now, the question is still though, is it better to buy right now here at the 11 o'clock, or should we wait till 1 o'clock or 2 o'clock? That's really what the question is, which I'm going to cover today. And this is exactly what people are asking me right now. And it is a very valid question. Now, I just want to let you know that what happens, the way we measure the property market is by the median price, which is not a very good way of measuring the market at all, in my opinion. But the median price is the middle property sold in one market versus the middle property sold in another market. And majority of the bulk of the properties there are here, and you can see this is kind of a bell-shaped curve that emerges, But this is not really a good way of measuring the market, because when there's a market downturn, people think that properties devalue. That's not necessarily true. What actually happens is that there's a more number of properties that are sold that are cheaper. So the median price shifts and actually goes down, but it doesn't mean that these properties here have devalued. It just simply means that the bulk of properties now could be 10 or 15% cheaper than previously in the peak of the market. And when the median price goes from 700 to 650, people assume that every property in Melbourne has dropped by $50,000. It's not true. In some suburbs, the properties probably have devalued by 100,000, but in some suburbs, properties have actually gone up or have gone sideways. And this is the biggest misconception about property cycles. People think that all 390 suburbs do the same thing at the same time, and they do not, and I'm going to prove it to you. If you look at the last property cycle, and I'm going to go through it in detail in a second, but if you look at it from a fundamental perspective, what we have in property cycles is we have this kind of a cyclical pattern that emerges where we have an emotional peak, which is the 12 o'clock on the property clock, where people just overpay for property. Vendors are unrealistic about what their properties are worth, and the market's meeting the vendors. At the bottom of the market, we have a reactive low where people are just panic selling, and a lot of people are losing lots of money there. But remember, this has to do with the median price. This hasn't got to do with every single suburb in Melbourne. And Warren Buffett says, be fearful when others are greedy, be greedy when others are fearful, which is very true. And I do the exact opposite of what most people do, and that's why I've got the results that I have. And I live by that rule for every aspect of my life, not just investing, but in my personal life, in everything else. Whatever the crowd's doing, if they're going left, just go right, because the crowd always gets it wrong. And that's a very important thing. If you look at the last really 20 years of property cycles, it is very cyclical in nature, but the last real boom we had was over here, which is 2001, 2003. And we had a combination of very high capital growth, say 20%, plus we had a huge volume of listings on the market as well. So a lot of houses were actually listed on the market. We haven't seen that since, and this chart doesn't really show you the volume, it just shows you the capital growth. We had a couple of peaks over here, and then we're kind of going into this kind of a sideways moving pattern over here. We definitely had some very high growth of 10 to 15% in Melbourne and Sydney, but really we're still waiting for that big peak to emerge. And my gut feeling is it's going to be 2018 and 19. And I think because the economy is so strong at the moment, and I'm seeing a lot of positive news coming out from the International Monetary Fund and the World Bank, I think you're going to see a massive spike in property prices in Melbourne in the next 2 years, where Sydney's already kind of had its growth. If you look at 2007, 2017, that's the last property cycle, but it's definitely true. We do have this kind of a high and a low. My strategy as an investor really is to try to lock in my lines of credit over here and buy properties at the bottom of the cycle. Now, there are definitely signals in the economy of where we are in the property clock, and look, every time we go around the clock, there are subtle changes. It's never exactly identical, but there are different things that happen. At the moment, we have increase in construction, which is kind of 11 o'clock on the property clock. And what happens eventually is at 12, we're going to experience rapidly rising prices. We're going to see prices go crazy for a short period of time, which could be 6 months or 12 months. Eventually what happens is property prices shoot up so much, the rentals stagnate behind the properties, and then you have an inverse relationship between capital growth and rental yields. So the higher the capital growth short term, rental yields drop as a ratio, not as a real dollar figure. Obviously rentals never go backwards, but they actually go backwards as a ratio. So what happens over here is people literally cannot buy properties because they can't service the gap between the rental and the mortgage repayments. And then you have a slowdown in the market. You have an oversupply of the property market because all this construction now is settling right here. So you have an oversupply of not in every suburb, by the way, this is just a generalisation. It's mainly apartments and house and land on the fringes of Melbourne. Then you have rising interest rates, okay, because the economy becomes a little bit sometimes overheated, and you're going to see an increase in rates. Already ANZ saying they're going to increase rates by the first or second quarter 2018. So we're already seeing that in the mix. Then we have lower property sales because the volume drops. Construction decreases because no one's making any money out of property. Then you have property prices falling. Now the fall in property prices has to do with the median price going backwards. Not every property in every suburb actually devalues, and I'll talk about that in a second. And then eventually here at 7 o'clock, you'll hear things like, rent money is dead money. Why would you rent where for the same amount per week you can own? Okay, and then people go, yeah, why am I renting? For $500 a week, I can buy a house of land, in Point Cook. So eventually what happens is your rental yields catch up to the property market. It takes about half the property clock really for them to catch up. Then there's an undersupply of rental properties. Okay, then there's a falling interest rate, rising properties, and around we go again. Now, where are we currently in the property cycle? This is where Melbourne is, right at the peak of the market. Now, how do you know it's there? Don't just take my word for it. It's because of Herring Todd White Valuers. Now, this company is the biggest valuation company in Australia, and every month they release a free month in review newsletter which documents every market and sub-market in Australia, every major capital city, right down to regional areas and rural areas. They talk about the residential property market, commercial property market, rural market, industrial market, every part of the segment. And we can see there, this is just from September 2017, Melbourne's right at the peak of the market, approaching the peak. So we're just over here, together with Gold Coast and Sunshine Coast. Darwin, Alice Spring, Gladstone, Mackay is at the bottom of the market. So it's very much a cyclical thing that's happening. Now, if you look at what's happening in Melbourne, right, let's look at the last 10 years of what happened in the suburbs specifically, because this is all fine from a big picture perspective, from a macro level. But let's have a look at micro level. What happened to individual suburbs? This is 2006, and these are the suburbs that hit $1 million in median prices in Melbourne. And you can see that 2006, 2007, 2008, you can see how it's kind of growing. 2009, and you can see this is the eastern part of Melbourne, and obviously that's where the growth occurred. 2011, all the blue chip areas in Melbourne that keep going up. 2012, 2013, 14, 15, okay, we're about 9 o'clock on the property clock, 16, about 10 o'clock, and 17, right, about 11 o'clock on the property clock. And so these are the areas now where the median price is $1 million, and really $1 million is nothing in Melbourne. You really need $2 million now for an average okay property, and 3 is a good house. That's the reality. So once again, this is what happens in the property market. This is the property market in Melbourne, from kind of the bottom of the market right around to the peak of the market. And so you've got to ask yourself a question, what's going to happen next time it goes around the clock? Well, I can guarantee you the same areas are going to do the same thing, okay? Because the growth always starts in the eastern suburbs. That's where all the money is in Melbourne. This is where the best schools are. This is where people have the highest income ratios per household. Okay, this is all money, and then you've got the Bayside, which is relatively new money. And then eventually all the suburbs fill in as well. But you want to be, if you're an investor, okay, you want to put your money into areas that take off first. Okay, you don't want to be putting in money into areas that take off last. And this is the thing with the property market is, people say to me, well, Konrad, we're priced out of the Melbourne property market. We've only got $600,000 or $500,000. What can we buy in the growth area? Well, first of all, there is nothing in the growth area that is 600,000 or 500,000. It's an oxymoron. You can't have something that's growing fast that's cheap. Okay, it's like saying, I want a fast, slow sports car. We're either going to have a fast sports car or a slow sports car. Okay, and if you're going to have a really fast one, 0 to 100 in 4 seconds, it's going to cost you a lot of money. Okay, a couple $100,000 probably brand new. You can have something that looks like a sports car but it's really cheap, it doesn't go anywhere, Okay, a lot of the Toyotas do that. Okay, but if you want a 911 turbo, you got to pay 350 grand. There's no substitute for it. So the thing about it is people say, can I get something cheap that's high growth? No, you can't. It doesn't exist. If it did exist, it wouldn't be cheap. It doesn't make sense. How can you have something that's cheap, that's high growth? It would mean that if it's been growing at 20% for the last 3 years, it would have been with 100 grand 3 years ago. Okay, so just think about it logically. You can't have it both ways. Okay, you can either have growth or price. We can't have both. Yes, I have a property that's a magical property that's really cheap. It's 100,000 and it's growing at 30% every year. It's been doing that for decades. No one knows about it. You know, think about how insane that statement is. So the reality is, where do you get started as the investor? The thing about it is that 80% of the growth is in the suburb. Only 20% is in the dwelling. Okay? 80% of the growth is in the area, 20% is in the type of dwelling, house, townhouse, whatever it is. So what you want to do with a budget is sacrifice the type of dwelling that you're investing in, but not the suburb. Because ultimately land goes up in value and buildings depreciate in value. Okay, and not all land is made equal. 100 square meters of land in Richmond will outperform 1,000 square meters in Point Cook any time of the day indefinitely. It's never going to be on par. So you want to secure whatever you can in the best suburbs in Melbourne with a little bit, long-term growth. Now, the thing about it is, people ask me, well, we're kind of at the peak now. We're $1 million basically. You can't get anything for $1 million anymore in a good area, apart from a townhouse. So where should we be putting our money? Should we wait for the market to correct? Well, I can tell you now, these suburbs here won't have a correction when we hit 1 o'clock, 2 o'clock, and 3 o'clock. These suburbs here, majority of the properties are paid off completely and they're unencumbered. The suburbs that will devalue are the fringe suburbs, where there's majority of debt concentrated and there's virtually hundreds of identical properties on the market every single week, and you cannot differentiate your stocks. So I'm talking about your Point Cooks, your Truganina, your Tarneets, your Roxborough Park, your South Morangs, your Peckenhams, your Berwick's, I'm talking about Sunbury, Melton. Those areas will devalue next time where we have a correction. And those properties actually will go down in value. So a $600,000 house in Point Cook will go down to $500,000 or $550,000, because you're going to see mortgage stress, you're going to see highly leveraged people losing their houses, putting them on the market, and there's hundreds of others that are identical in the market. Okay? These areas here will never devalue, even during the decline of the market, because these houses are paid off. These people choose when to sell and when not to sell. And even if there is a bankruptcy in Albert Park or Middle Park, that property will be snapped up anyway, because there's virtually no stock on the market. You have a look at realestate.com right now and type in Albert Park, how many houses come up? You'll find it's about 7. You type in Point Cook and there's 350. Supply versus demand, and that's the reality of the market. So what are the best types of properties to target in Melbourne? Apartments you have to be very careful with in Melbourne. We have a massive oversupply with apartments right now in 2017. This is just an aerial view of the Melbourne city. These are the towers that are getting in construction right now in Melbourne. Have a look at it. I mean, for me personally, I think it's a phenomenal thing. We're going to be like Manhattan, New York. It's a matter of time. And why shouldn't we? Melbourne is the most livable city in the world 7 years in a row. So this is definitely a good sign of maturity. The fact that we have all these cranes on the horizon means that Melbourne's doing really well. I love the fact we're building all these apartments. Awesome. As an investor, wouldn't touch them. Guaranteed to lose money. You're not going to see any growth for the next 10 years. I've got clients that have bought Docklands in 2007 and they've bought a 2-bedder for $550. We had it valued the other day and the valuation came in at $525. So 10 years, forget about zero growth, they lost $25,000 and they're paying $3,700 per year in owner's corporation fees. Insanity, So definitely great to live in if you like city living. Phenomenal for our city, really bad investment. And this is why these postcodes have been blacklisted by lenders. You have a look at the apartment blacklisted by the major banks in different major capital cities. In Melbourne 3000, 3004, World Trade Centre has been blacklisted. South Bank, South Yarra, Docklands, South Melbourne and South Melbourne, DC, all blacklisted by lenders, meaning the maximum you can borrow is 80%. So lenders' mortgage insurance won't go into those areas. but you have cash out restrictions, and LVR could be as low as 70%. So imagine you buy a $600,000 two-bedroom apartment, you might have 30% trapped in that apartment and never be able to get that money out. Think about the opportunity cost of having that money trapped in that property indefinitely. You know, it's not a good use of your money. So the only apartments that really work in Melbourne are ones that have a 3-to-1 ratio between the price of a detached house and an apartment. So for example, in Toorak, okay, our most expensive suburb, the median price is $3 million. Okay, it's closer to 4 million now. The average two-bedder is 672. There's a 3.4 ratio between the price of a detached house and an apartment, which means that this person here isn't competing with this person here. He's either going to live in Toorak in a two-bedder or he's not going to live in Toorak at all. This is a completely different market. Where the prices come together very closely, okay, like Mitcham. I love Mitcham. Maroondah Highway is fantastic shopping. Love Mitcham, very green, very cool. Apartments will never work in Mitcham, okay, because you can get an apartment for $550, $600, and you can get a house for $850 to $950. They're too close together. The person that's going for a $600,000 loan can possibly get a $900,000 loan. So where you're competing with apartments and competing with houses, you won't get any growth. Where you will get growth, where there's a massive gap between the price of an apartment and a detached house. And these are the fastest growth areas. So we're talking about Toorak, Dippendy, St Kilda West, East Melbourne, Kew Glen Iris, you know, Gardenvale, Hawthorn, Armadale, Middle Park. House and land are an absolute disaster in Melbourne. Now, when I mean disaster, you might not lose money in every estate, but you're not going to create enough equity the way you'll be able to draw equity out and go again and again every decade. And that's the challenge with house and land. And yes, you get the most for your dollar. You get a big house, 4 bedroom, 4 bathrooms, double lock-up garage, huge blocks, 600 square meters. So you get massive value for money, but you get very low capital growth in return. You know, and in 2012, we had the biggest glut of house and land estates hitting the market. This is where people were defaulting in mortgages, and we had a lot of record mortgage stress in Melbourne. Have a look at in June 2012, the amount of properties that were actually on the market. In Hoppers Crossing, Truganina, Tunneage, 4,048 homes. Cranbourne, south, north, south, east, west, Sandhurst, Sky, 3,931. Doreen, Mernda, 3,718. Derrimut, Point Cook, Werribee, 2,961 houses listed. Think about it. How can they go up in value? There's thousands of them listed. There's not enough buyers. It's oversupplied. Pakenham South, Melton West, Roxborough Park, Craigieburn, Clyde, and Epping. So what happens is during the correction, these properties would devalue in these suburbs, okay? And the median price will drop as an overall median price. But I can guarantee you, 1 o'clock, 2 o'clock, 3 o'clock on the property clock, right down to 6, Albert Park, Middle Park, Port Melbourne, all the blue chip areas in Melbourne, you know, they're gonna just stay exactly the same. And if there is even an inkling of a bargain with a property, 10 people will turn up to the auction and they'll just bid and destroy the discount on the property anyway. So there is no bargains during the slowdown of the property cycle. There is just wishful thinking. So just keep that in mind. And once again, if you look at the last 10-year growth of the so-called growth areas in Melbourne for house and land estates, they've been an absolute disaster. Melbourne, which has the highest population growth in Victoria, last 10 years has grown by 2.5%. Now, the inflation rate is 3.75 on average. So these properties actually, people are losing equity in these properties. Nothing to do with lifestyle, by the way. I'm talking about pure capital growth. Officer, Cardinia, you know, Mornington Peninsula, Red Hill South, you know, Williams Landing, all this crap I'm hearing about Williams Landing in Melbourne. Like everyone from Toorak is going to sell up and move to Williams Landing. Williams Landing has done absolutely nothing, 3.2% for the last 10 years. You know, Truganina, Tarmeet, you know, St Albans, all the usual suspects. You look at the best areas in Melbourne, they are really areas where you need to buy a townhouse. And townhouses are the best vehicle for the average investor to build and structure their property portfolio, because effectively what you have is you've got a house with no backyard. So you're tapping into an established area with established infrastructure, schools, transport, everything, lifestyle amenities, but you're sacrificing the backyard. And really, people don't want backyards anymore. They just want a small courtyard to entertain their friends and family. No one wants a third acre anymore to look after it, especially with tenants. So these are the best areas to target for townhouses. You know, your established blue chip areas. I know they're expensive because even in the best areas now, 2-bedroom townhouses, like areas like Bentley, McKinnon, Brunswick, they're selling for $850, and 3-bedders are going over $1 million, for an average townhouse. And you look at the growth of those areas, Mont Albert, 11.8%, Bowen North, you look at the growth of the best suburbs in Melbourne, Middle Park, 11.1%. That's what you want to tap into. So as an investor, what I encourage you to do is forget about trying to get the timing perfect, okay? If you do, you're going to make yourself crazy. What you want to do is just buy as much as you can, whenever you can, which is 1 or 2 properties a year anyway, realistically, but you want to target the best growth areas. Don't sacrifice the area, sacrifice the dwelling if you have to. But make sure you have money in these top areas in Melbourne, and that's where the growth will occur. If you think that Secure the West is going to devalue during the downturn and wait for a bargain, it's not going to happen. If anything happens in Secure the West where there's a bargain, investors like me will step in immediately and snap it up. There is no bargains in those areas. So I hope you enjoyed that video, and I hope it guides you, because I've been through a number of property cycles. So for those who listen to this video who have never been through a property cycle, that's what's going to happen next time. It's very predictable. There's really nothing to learn from that perspective. Remember, it's all about timing, time in the market, and compounding, not getting the timing perfectly. If you're interested in learning more, I encourage you to attend one of my up-and-coming real estate investing fast-track weekends. All you got to do is go into that website or scroll down below. There's a link just under this video. Click and register yourself for an upcoming event. I only run 10 of these per year. I only run them in Melbourne. They're a 2-day event. It's an incredible event, by the way. There's a number of really good speakers. We've got Stephen Molnar, who's a property specialist and strategist for over 20 years. We have an accountant, Martine Angelique from Savvy Accounting Group, Cameron Fisher from buymyplace.com.au, and he's also a registered valuer. I myself talk about real estate and finance, and Stephen McClutchy from Loans Australia, who has settled now over $1 billion in investor lending. So it's a great panel of experts that you can learn from, especially for those who are starting out and getting their foot into the property market. So once again, the Real Estate Fast Track Weekend, very limited seating. There's only 40 seats available per event. They're in our office right here in St Kilda. So for those of you who are interested, book in, and I hope to see you at the live event. The next one is coming up very shortly, and I believe we've only got a 1 or 2 left for 2017. And I can tell you now, there's a bit of a waiting list for these events now, which is quite good. So I'm considering running more of them next year. Day 1 is a property due diligence and live workshop where we talk about, finance, structuring, getting the market, getting you market ready, getting a plan done. Day 2, we put you on the bus and we actually take you out to 6 different development sites in Melbourne, and you get to do live due diligence on projects. And this is where a lot of people lack experience. How do you do cash flow analysis comparison on different properties? What do you look for when you're looking at a property? Do you look for depreciation, rental yields, capital growth? If so, over what period of time? All those questions will be answered on day 2, which is amazing. And most people, when they go through day 2, it basically it cements all the theory and links it to a practical application, which is really cool. These are my favorite things that I do all year round, by the way. And once again, for those who can't make it, I encourage you to get a copy of my book, which is Australian Property Finance Made Simple. You can get it on Amazon or Book on Finance. Also, as I mentioned at the beginning of this video, and because you stayed to the very end of this video, you're going to get access to a recording of the Real Estate Investing Fast Track Weekend from 2 years ago. They are $497, and you can watch this as a home study, free, no strings attached. All you got to do is scroll down below on the second link. You can see the URL, and that gives you access to this home study immediately. The home study is amazing because really, from a fundamental, large or big picture perspective, nothing's really changed in the last 10 years. It's the same stuff over and over. From a micro level perspective, I'm talking about lending policies, suburbs, where to target different properties. The only constant is change. I mean, it's changing every week, but from a big picture perspective, these contents won't change in the next 10 years. So you can watch this home study for the next 10 years. I won't go through what it covers, but it's very user friendly. Once you get into the main page, you literally just point click. You've also got a manual here, which has 395 PowerPoint slides that you can just print off or have it as a PDF document, and you follow everything that all the speakers are going through. So that's a small gift for you guys, just for staying tuned and watching my YouTube videos. And it's absolutely free access. You can access this right now, absolutely for free. And you can just go to that link there, or scroll down below. There's a link for you to click just under this video, and you can access that information right now and continue your education. Remember, personal education always pays the highest dividend. Traditional education will make you a living, personal development will make you an absolute fortune. And that's the very wise words that my mentor keeps talking to me about for the last 10 years. Guys, it's been great, fantastic. Thank you very much for watching this video to the very end. And I'll see you on the inside. This is Konrad Bobilak, CEO of Investors Prime Real Estate.